What's up, guys? So today we're going to be talking about one of my personal favorite subjects, and that's value investing. Now, if you've been involved or researched the field of modern day finance, I'm sure you've heard of the term value investing as an investment strategy, mostly because a lot of the top money managers in the world, we're talking Warren Buffett, Ray Dalio, Carl Icahn, Nelson Peltz, Bill Ackman, pretty much all of them who have achieved a lot of success over the long term have done so as value investors. Now, if you want to be successful in any field, you rarely have to, come up with something revolutionary or reinvent the wheel. A lot of the times, all you have to do is look at those who have succeeded in the past and understand their philosophies, their strategies, their best practices, and just implement that in your own approach in that field. It's not a coincidence that Kobe Bryant's game was very similar to Michael Jordan's. There's been a ton of videos showing them side by side, and it's like almost identical.
If you electronically switched the uniforms and played that at full speed, you would not have been able to tell who was who.
It's not a coincidence, and that strategy of modeling yourself after greatness can be applied to pretty much any field. So a lot of these money managers have no problem discussing how they make an investment, what they look for, and their general, overarching investment philosophy, which is primarily the value investing principles. But they rarely elaborate as to why this strategy works better than other investment or trading strategies. So here in this video, we're going to go over the top 4 tenets, the top 4 rules of value investing, and we're going to go more into depth to prove why mathematically and graphically value investing principles are going to achieve higher returns long term than these other investment strategies like technical analysis and day trading, momentum trading, stuff like that. If you're in this for the long term and you plan on investing your money in the stock market for the rest of your life, which is what I plan on doing, then this is going to be absolutely critical information. So if you're interested, watch to the end. Let's jump right in.
First rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
So value investing rule number 1, don't lose money. Now, I know that may seem like such an obvious rule. It's like, yeah, no duh. When you invest, you want to put money in and you want to take more money out. But that rule is actually a lot more profound than it may seem on the surface. If we're just to look at this from a mathematical perspective, let's say you have a portfolio and it's $100,000 and you're trading it, you're investing it, whatever, and it goes up, it triples. It goes from 100 to 300,000. That's really great, right? Well, if you make some bad trades and then your portfolio loses, so it goes up 200% from 100 to 300,000. If you make some bad trades and you lose 66%, or you're in a bear market or whatever, you just lost all your gains. And you can see that again, your portfolio 10x's, it can all go away if you lose 90%. So another way of thinking about this is risk reward or offense defense. If you're going to war, there's a reason why Roman soldiers didn't go to battle with 2 swords in their hands and just wearing their regular clothes. You're dealing with something serious like your life savings or your life. You want to approach this with both an offensive and defensive strategy. You don't want to just be all offense. And that's what investing in a high-flying speculative stock is like. You're thinking only offensively. A good example would be GoPro. I remember when it came out, it went public in 2014. There was all these stories about it. Oh, it's not just a camera company, it's a media company, and everyone loves it. It's a great brand, and it was valued way above what any of the fundamentals would suggest. I believe it was trading at almost $100 when it peaked. When that amazing story that GoPro was going to do all these amazing things didn't come to fruition, the stock tanked over 90%, and it stayed there. It's been trading below $10, between like $3 and $10 for the last 5-6 years. One of countless examples of why you need to not just think offensively, what's the potential upside, but you also have to think what's the potential downside if that narrative winds up not being accurate. And for those who think that a stock, if a stock declines, you're going to be able to get out of it in time, but you're not going to wait for it to go down 90%. A lot of times you don't have that luxury of seeing it decline slowly. I remember a friend of mine who invested several $1,000s in a vaccine company called Novavax. And there was this story about them. I forgot what publication, it was like Motley Fool or something. But there was this story saying, oh, we're going to come up with this vaccine and it's going to be a huge multi-billion-dollar, it has huge potential. So the stock ran up and my friend dumped in, I think, $5,000 in it. Well, there was a trial, I think it was one of the vaccine trials, that got really bad results. And literally overnight, the stock dropped well over 80%. So literally he owned the stock, say on Tuesday at $5,000, and then the next morning it's trading at under $1,000. That's his position. So that's devastating. You have one of those, you're pretty much finished, because he's gonna have to, almost 10x his money to recover those losses, which could take you decades, if ever. So you want to be able to stay in the game, and that's how you do it, by playing offense and defense, thinking about the downside as well as the upside, because that Novavax loss was pretty brutal. As a matter of fact, whenever we're going to describe a portfolio blowing up or a huge loss happen, we're going to say that's getting Novavaxed. So you got to remember to play defense as well. You can't just be thinking offensively, what's the upside potential, and then you wind up getting Novavaxed. So the way value investing also takes a defensive strategy into consideration is if you have a quality company that you buy that has the fundamentals, that has a good balance sheet, like let's say Facebook or Apple, for example. They have tens of billions of dollars in cash and cash equivalents. Apple has hundreds of billions. And the thing is, they almost, because they're such a good company, they're so profitable, they have such a good balance sheet, they have a de facto floor on the price of their stock. If their stock drops too much, one, they could just buy back shares with all the cash that they have, all the profits that they've made. And two, as I mentioned before, the vast majority of money managers, the guys controlling hundreds of billions of dollars, if they see a quality company's stock dropping for no warranted reason, they're going to just swoop in, and you're going to see tens of billions, if not hundreds of billions of dollars swooping in and just buying up that stock, giving it a de facto floor. So anyway, long story short, don't lose money. Think defensively as well as offensively in your investment strategy, and don't get Novavaxed.
If you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise, you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do?
All right, number two, focused on the fundamentals of a business and not the stock's price action. Now, when you buy a stock, of a company, you should treat it as if it's a small portion of ownership of that company, right? And the reason you should treat it that way is because that's exactly what you're buying. You're not buying some ticker symbol that's just fluctuating and you can kind of guess which way it's gonna go. That's how a lot of people treat it, unfortunately. But what you're really buying is a small portion of ownership in a business. So if you're gonna own a business, what do you wanna know? You wanna know what that business will earn. You wanna know what it's gonna earn over the years. Think about all businesses as being machines. In this machine, you put in a certain amount of money. Let's say you put in $15 million this year. And by the end of the year, it produces goods and services that it sells for $20 million. So there's a differential of value creation and money that you earned, an earnings of $5 million, or what, a 25% profit margin. That's basically how all businesses work. They're machines that you put in capital and it spits out goods and services that are sold for more money than what you put in. That's basically all business in a nutshell. Now, unfortunately, when it comes to stock, a lot of people don't see it that way. They focus on the price action. If they were honest, they would say, well, the stock price, it's gone up, 50% this year. I think it's going to go up another 50% next year. And then they listen to some story about why that stock has a lot further to go, and they just dump their money in. They really focus on the price action. They have FOMO, fear of missing out, and they see people making money. They want to dive in. They don't care about the fundamentals. They don't care about the business's metrics or its earnings or its balance sheets. They're focusing on the price action, which is absurd. If you think about it, let's use a recent example with GameStop. So if you saw GameStop's stock going way up, you hear all the controversy, Wall Street bets and all that, and you buy it at, say, $100 a share. And then a week later, you see it shoot up to almost $500 a share. That's when it peaked. It peaked at like $483. And then, so that was on January 28th. A week later, so you're thinking you're a genius, right? You're thinking it went up from 100 to almost 500. You 5x your capital. You're a genius, right? A week later, it dropped down to about $50 a share. So now you lost half of your money. So what were you? Were you a genius that knew what they were doing when it was up 5x? Or are you a knucklehead that has no clue what you're doing when the stock's been cut in half and it's going to go a lot lower, by the way? No, you were always clueless. You always didn't know what you were doing. This whole idea that the price of a stock, the short-term price fluctuation mean anything is wrong. It doesn't. Okay? It doesn't really tell you. It just tells you that's how people are feeling in the short term. There's this old saying, I believe Benjamin Graham said it, that in the short term, the stock market is like a voting machine. Whatever people feel, they vote with their dollars. But in the long term, it's like a weighing machine. Long term, remember this, long term, the earnings of a company 100% correlate with the company's stock price. You're never going to see examples of long term, okay? Short term, you never know what's going to happen. You'll never see examples of a company earnings going up and up and up year after year after year and the stock going down or staying stagnant. The stock will go up. People will buy the shares. It will push the price up. There will always be that absolute correlation between the money a company makes and the value of its shares, period. If you're going to buy shares in a company, you need to be looking at their earnings reports and their balance sheet and look at all the trends of every important metric for the last several years. If you're not doing that, you have no business investing in individual companies. Just if you don't want to put in the effort, just buy the S&P 500 and you'll probably do even better. So if you want to buy individual companies, ignore the short-term price fluctuations. Focus on the business's fundamentals. You are owning a share of it.
If we could see in it, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct. and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate the strengths and weaknesses of the company, and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out, not by selling it to somebody else, because that's just a game of who beats who, but in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business.
Number 3, determine a company's intrinsic value, buy it at a discount. So when you're crunching the numbers and you're trying to estimate that company's future earnings and cash flows, you are basically going to have to develop a range, okay? You're going to put in the positive and optimistic estimates. So you develop a top of the range of what those earnings, those future earnings can be. And then you're going to have the more pessimistic outlook for the company to develop the bottom of the range. So let's say you do this and you determine that a company's valuation should be somewhere between 10 and 20 billion dollars. And then there's a billion shares outstanding. So the stock price, if you were to discount it to present day value, should be somewhere between $10 and $20. And you're going to get pretty sizable ranges because, we're talking long durations of time and we're talking pretty cloudy assumptions. So you're going to have pretty sizable ranges. Something like that isn't too uncommon, $10 to $20 per share. So if that stock is trading at less than $10 a share, that's going to be a good candidate for potentially a long-term buy. But if it's trading at $30, $40, $50 a share, obviously you're going to want to leave it alone. So when it comes to value investing, this buying at a discount could be called a margin of safety. It's not exactly a hard rule, okay? It's kind of a soft rule that Warren Buffett actually breaks a lot of times. One of the things he says is, I'd rather have an excellent company at a fair price than a fair company at an excellent price. And it's worked out for him. So, if you can find an excellent company that's still within that range, but, maybe towards the center or maybe a low end of the range, that may also still be a good candidate. You don't have to get it at a deep discount.
I would just do a whole lot of reading. I'd try and learn as much as I could about as many businesses, and I would try to figure out which ones I really had some important knowledge and understanding that was probably different than overwhelmingly most of my competitors. And I would also try and figure out which ones I didn't understand. And I would focus on having as big a circle as I could have, and also focus on being as realistic as I could about where the perimeters of my circle of competence were. I knew when I met Lorimer Davidson in January of 1951, I could get insurance. I mean, what he said made so much sense to me in the 3 or 4 hours I spent with him on that Saturday. So I dug into it, and I could understand it. My mind worked well in that respect. I didn't think I could understand retailing. All I'd done was work for the same grocery store that Charlie had, and neither one of us
learn that much about retailing, except it was harder work than we liked. And
Number 4, stay within your circle of competence. Now, this one gets violated all the time. You have money managers or just individuals, retail investors, that they don't really have a deep understanding of the company that they're buying shares of. They don't have a deep understanding of the market that company's in. So they're venturing out of their circle of competence. One way to explain this graphically is basically you have 3 circles. You have the small circle called your circle of competence. That's basically what you can understand. You don't have to be an expert at it, right? You don't have to be an executive at Facebook to understand how their business works and how they make money and their market. You don't have to be an engineer. You don't have to know the inner workings. You basically just have to have fundamental understanding of that market and of how that business works. Once you have that, then you know that you're operating within your circle of competence. The next circle outside of that is the region that you think you understand, but you really don't. That's where you're more likely to get into trouble, where you think you know what you're doing. Like a lot of people, one thing I noticed is people buying cryptocurrencies. They read a few articles and they think they're a fucking cryptocurrency expert and they know what they're doing. It's probably not going to end well, because whenever you think, it's called being just smart enough to get yourself in trouble. You get more bold and you're willing to invest more, or I should say gamble more. So you want to make sure that this zone, you want to keep an eye on it. You don't want to be investing in an area where you think you know what's going on, but you really don't. Even the best of us get that. Warren Buffett himself, he thought he understood IBM's business, and that's not turning out too well for him. And then the circle outside of that is the zone where you just don't know. You just can't, you don't understand how that business works. You don't understand that market very well. You don't understand how they make money, what their competitive advantage is. You just don't know. And whenever you don't feel confident that you're within your circle of competence, just don't buy it, okay? One of the things that Warren Buffett says is that when it comes to investing, there are no called strikes. And what that means is you don't have to swing. You don't ever have to swing. You could just sit there and wait and wait and wait until you see something that meets all your criterias, and then you could swing. Okay, so nobody's forcing you to invest in anything. I don't care how much it goes up. I don't care how much people saying it's going to be the next big whatever. You don't have to invest. Okay, if I don't see an opportunity that's within my circle of competence, that I see as being at a discount, that I see with a ton of upside and little downside, I just don't invest, and I just keep it in the S&P 500. If you don't know what to do, you don't have to do anything. Just keep it in the S&P 500 and you'll do just fine. Now, I hope this kind of explained why, if you're going to be in this long term, if you're going to be investing for decades, for the rest of your life, hopefully, that value investing is the ultimate, it's the only real strategy that has been time tested and proven to give you good upside, better than market upside a lot of times, with also a ton of downside protection, which I hope I explain why that's so important. So if you like this kind of content, subscribe, leave a like if you got some value out of this, share if you think someone else could benefit from listening to this content. And yeah, I appreciate you from watching, and I'll see you on the next video. Oh, and by the way, don't get Novavaxxed.